times. And so I want to welcome everybody to the How to Make Money Trading Stock Show with today Mike Traeger's joining us. Michael Bishop is off skiing and I guess in the Swiss Alps or something. Hi, David. And so Mike is joining us from Dallas, Texas. Mike, is it springtime in Dallas yet?
Yeah, it certainly is, and for the most part, we're having good spring weather with a little bit of rain sprinkled here and there.
Cool. And one thing I used to love about when we lived down in Austin is on some of the rolling hills around Austin in the springtime, those Texas bluebonnets would come out, and they were absolutely gorgeous. It would turn complete fields into this beautiful kind of purplish hue, and really, but you got to get outside town to be able to see that kind of stuff. So I want to remind everybody that all the materials we do present are for training purposes only. Traders should always paper trade any new method prior to the risk of their own personal capital. Michael's not with us today. This week, I believe in continuously educating oneself about the market. So this week I have been doing some online courses, checking out some various things. I always like to continue sharpening my saw when it comes to technical analysis. We do the same thing with the active trend trading system service. Last week we did a real good presentation on the convergence of clues. We've been having a series of kind of lessons, our curriculum over the last several weeks that hopefully is building folks their toolkit, if you will, on how to handle various market situations. And this week we're going to be basically kind of tying it all back together so that one can predict, high probability entries and exits. And so I know you're a big one, Mike, on continuing your education when it comes to trading, and that's one thing that you're a real student of the market, and that's one thing I like about one being your friend and also working with you, is that we have that similar interest, right?
Yeah, I was even watching a webinar last night, which was a rehash of a lot of stuff that you and I already know. But it never hurts to do a refresher here and there.
Without a doubt. And then what I like to do is if it makes sense and it tests out okay, sometimes we'll go in with the active trend trading system and do some refinements so that my objective is to continuously try to clarify and simplify for folks who want to become who are active trend trading members. I got a really great email from one member who took it serious about just honing in on a few clues, convergence of clues, just honing in on a few, and she basically just uses a couple of clues, but when she gets those clues, she takes action. And so, she was saying, my paper account is up over 20% for the year. I'm really excited about that. Just darn, I wish I would have had it in real money. But at the same time, hey, you got to learn the paper account first and then move on. So, Mike,
actually that's okay, because when whoever that person is, when she starts using real money, she'll have that much more confidence in what she's doing.
Oh, without a doubt. And so this week has been a very interesting week. Mike and I read several people. One of the persons I was reading over the last few days was making the comment of, this market doesn't make sense. We can't really, I lost audio. There we go. Audio's back. We can't really put our finger on, okay, why is the market responding and going up the way it's going up when in reality nothing has changed. However, with Draghi's announcement last week with the ECB and then the Fed announcement this week, the Fed has basically dialed back their rhetoric with regarding being hawkish on interest rate hikes. And Mike, you were mentioning that while the market has continued to push higher over the last at least since the Fed meeting, it seems like the market liked what the Fed had to say. Um, outside influence, what to do with all that free and easy money. But you had some comments on explanations of why the market's doing what it's doing right now.
Oh, yeah, there's a couple of points to make about that. I mean, and some of it ties into, for anybody who, might want to know a little bit about currency trading and forex trading. Part of what you learn when you're learning about trading currency pairs, not currency futures, but currency pairs, is that, every nation has its own sort of general interest rate.
Right.
In the United States right now, that's about 0.25%, and in Australia it might be different, and in Switzerland it might be different. Switzerland's actually negative now. But when you purchase a currency pair, and let's, for example, discuss briefly the Australian dollar, US dollar currency pair. Well, it wasn't too long ago that interest rates in Australia were running around 4%.
Yeah.
And certainly that was better than, what the prevailing interest rate was in the US at that time. So when you make that transaction and you buy the Australian dollar, that interest rate, prorated down to a daily basis, that interest gets deposited into your account where you're holding the currency on a daily basis. So when interest rates change, whether up or down, it can affect the value of the currency, because certainly the more interest you get paid for holding the currency, the more attractive the currency is, and so the higher the value of the currency is relative to other nations, other currencies. So what happened here with the Fed a few days ago? Well, the Fed basically said, yeah, we're not going to raise rates as much as we thought we were going to. So that, at least temporarily, drives down the value of the dollar, because the rate hikes that were expected are no longer in play, and so the dollar gets sold off by the institutions who trade these things actively. When that means that everything priced in dollars becomes a little more valuable. U.S. equities priced in dollars will want to go up. Oil, certainly priced in U.S. dollars, will want to go up. And that's what we've seen happening here the last few days. So I know it's an explanation in hindsight, after the fact, but when you know these things and these developments crop up, you can reasonably start anticipating some things, and that's part of what's going on right now.
Yeah. Yeah. And so, one of the things you did mention oil, and I'm still counting oil as basically an outside and earnings influence on driving the market. And from $25 back up to, oil's sitting about $41 right now.
About 42 actually.
Okay, so it's about a 60% gain in the last 3 weeks.
Well, 4 to 5 weeks.
Okay, very interesting. And then also, bad news continues to be good news, because from an economic standpoint, by the Fed backing off of their hawkishness and becoming more dovish on interest rate hikes, in a way, they're basically saying, hey, we don't think this economy is as great as what we possibly thought it was previously. Maybe it's not the recovery is under concern. So on the individual rest of the tracking indexes that we track, the NASDAQ 100 is at resistance of the 200-day moving average. And then the Russell, which is very pleased that the Fed is looking at being a little bit more dovish, uh, appears to be moving up to its next resistance. Now, the question that I have going into next week as we get ready for it, are we at the point where it would make sense for people to start taking profit and perhaps drive the market down a little bit? And when we look at the chart, we'll have some indication on that. But that is definitely a potential because the market has been on a tear for the last 26 trading days. That's that's over a month's worth of trading. And there's some symmetry we want to compare with when it rallied last October with a very similar looking rally. So anything else on this area, Mike?
No, not really. Not unless you want me to get on my soapbox again. Don't know that we have time for that today.
Okay. And so now we're moving into a short week next week because there's only 4 trading days next week because Friday is Good Friday, and so people will be not trading. So here's where we were on the stocks above the 20-day moving average. Last week we were sitting above the 80 level. And what has happened this week? We actually had a little bit of a drop off, and then we're kicking back up today a little bit. And I basically indicate that, okay, this is Friday, Monday, Tuesday, selling off in preparation for the Fed. Fed does its announcement, and then we get this nice little rebound. We've seen that on several stocks. What's interesting on many of the stocks, though, they're emulating a similar pattern to the indexes, and that they're still in a longer-term downtrend, but they've been in one heck of a rally over the last few weeks, and so that's kind of an interesting thing to watch. As we've said in the past, that this particular indicator is not really a good indicator for determining where tops are. It's more of a bottoming indicator. It works better at that point. But we can see that, hey, we have, folks have done a little profit taking and pulled off and bounced back up. And then I also like to take a look at the percentage of stocks in the NYSE or this composite of the stocks that are above their 200-day moving average. And this week, what I threw up as a comparison chart is the S&P. Now, actually, the spider is as a proxy for the S&P, and I'm intrigued a little bit, Mike, by a couple of things that I'm seeing here. Let me get the drawing tools back up. A couple of things I'm seeing here. Okay, the S&P has come in and put in basically and this is the monthly chart. We've got a top up here just above 210, and we've got this support level down here. And it's kind of interesting as look at, we have a similar type of thing going on down here with the percentage of stocks above their 200-day moving average. And it in itself, and that's one thing that's nice about technical analysis, guys, is that you can take a indicator like the percentage of stocks over the 200-day moving average, and you can still draw in lines of resistance, lines of trend lines, and all of that type of thing, and they're still relative to your analysis. And so we've got and the point I'm trying to make is, okay, we've got the S&P working within this channel in a downtrend. And we now have the percentage of stocks above the 200-day moving average also working within a channel that is in a longer-term downtrend. It may have broken out a little bit, but it's still in a longer-term downtrend. And so, Mike, what conclusions can we draw from this?
That's a good question. I don't know.
Okay.
I don't know. I'm all ears waiting to see what you might postulate.
Well, one of the things that I'm looking at is, while it is a positive sign that more stocks are moving above their 200-day moving average, that's telling us also that um, the 20-day moving average and the 200-day moving average actually are coming into a squeeze or coming closer together. Um, it's telling me that, you know, we could be in a market that is going to be range bound for a while, because we could very well, while many people believe the S&P is going to do this, we could actually have it where the S&P does something like this and just works within, and it's not unusual for it to work within just a sideways moving, range bound trend. And if that's the case, where we need to be paying attention is, where is it turning around at? Because that's a pretty nice, because the move from here to here is about 13%. So if you add the whole thing together, you're probably looking at about a 17% range on the S&P, and each of the other indexes are showing similar type situations. And again, until we get in, and we know that if we look back here in 2008, the 2007, this indicator puts in a nice topping. This is a head and shoulders type pattern, and then falls out of the sky. Make sure I'm looking. Yeah, and at the same time, we get the S&P following it a little bit later, falling out of the sky and dropping. This was the big correction that started at the end of 2007, and if we're in a similar type place, we're about right here right now. Comparison with where we're, if we can try to compare the two charts. And so it's kind of interesting, because I can see it kind of going one of two ways. Oh, good. I just have my klaxon go off telling me something's diving. So that's what I'm seeing right now. In a classical technical analysis, is it would not be uncommon for, if the sellers gain control, take back control of the market, it would not be a surprise for this move to be just about at an end, and for a potential rollover to take place. But then at the same time, we've got a huge amount of support in this area down here between, it's about 195 on the S&P, on the spiders, to to just above 190. So that's what I'm seeing. Was that enlightening?
I think when we get to the index charts, I was just looking back. I was just looking at it last night or this morning at like 2007, 2008 on the monthly chart of the S&P, and some very eerie similarities to what's happening now to what was happening then.
Yeah.
Before all hell broke loose back then. And when we get to that, let's take a look at that. I think it's pretty interesting.
Okay. And so one of the things that also I find very interesting that could potentially, and I'm not per se bearish, because like I said, we need to go the direction that the market's going. But one of the things that, if we are, if this current move up is just about exhausted, and the sellers come back in with a vengeance to take this market down, because of the weight that's happening from all the debt that we as a country have put on since this period here up to this period here, and some of the other, the debt bubble starts to drop off, to continue to expand or even potentially burst, then we could have a significant fall. And it would not be, surprising to see us, back down here on the S&P, on the spiders, back down here, at the 155 level. Gino makes a comment slightly off topic, but is there somewhere I can put some money to work for 2 to 3% FDIC insured?
No.
Okay.
No, we're not in an environment now where that's possible, and unless you want to, go out and buy like a 30-year Treasury bond, but that's not FDI insured,
Yeah.
and there's certain capital risk with Treasury holdings.
And so, okay, I'm just looking here at Google. I had a. You're welcome, Gino. I had a spread going on Google that made fire off and close out for a nice profit, but that was one of the things that, for those of you who are interested, those of you who are trend trading members, I'm going to be putting out some, I've asked the question of folks who would like to get involved with getting alerts on some different kinds of option trades, because the option trades that we've been doing so far this year have been very, very good to us, and we're going to try to increase that. So, okay, as of 9 o'clock, we were sitting with the Dow and the S&P now positive for the year. However, since 9 o'clock, that may have reversed itself there, but it's off the high from 2015, this amount. NASDAQ 100 still negative for the year. The NASDAQ Composite negative for the year. Russell still negative for the year, but now it is performing better than the NASDAQ. So what we've got is we've got the tracking indexes we track are the S&P, the NASDAQ, and the Russell. We now have a new pecking order, 2 and 3. So with 1 being the strongest, 2 being in the middle, and 3 being the weakest of the indexes that we're watching. That's on a yearly basis. And so so that's where we're sitting. And then we're going to go to the charts here shortly. Somebody sent me I found it somewhere. No, yeah, somebody sent me I grew up down by Monterey, Salinas, California, and whenever you have a big rainy season, the poppies in springtime just come out dramatically, and I just thought this picture was amazing. It was shot on from just off the road on Highway 1, driving down from Carmel down through Big Sur and all that kind of stuff. Dramatic coastline shot, and the golden California poppy. And so, one thing, even though California is really screwed up with its politics, it is still a beautiful place. It really is. No comment, Mike?
No. Okay, California, the coastal California anyway, is undeniably beautiful.
Yeah.
The price of it keeps going up, but can't deny it. I mean, I was practically I am practically a native and lived there for, a portion of my life.
Yeah, and so okay, Gary. Yeah, Gary, if you just send me an email on that to let, and that way I'll get you. If you're not on the option list already, we'll get you on the option list. So let's take a look. Here's the S&P. One of the things I highlighted on Wednesday night was, and I've kind of just left this in place. One of the things I highlighted was this trend channel that's heading up. However, if you notice this, that it is pinching in. Well, what this is called up is an ascending wedge. And as you can see, if you draw this line far enough, eventually they intersect, but it's called an ascending wedge. Ascending wedges tend to be bearish formations. However, there's no action to be taken regarding this particular, it's going to continue going up until it breaks out and closes below this trend line here. And as we can see, we have gone up like very significantly over the last 26 days. Matter of fact, we are almost up 13% or so after going up for the last 26 days. We've got this downtrending resistance line that's formed from this top. This is November, this is December time frame, and as you can see, prices tried to push up to that, but they hit the 150 level and appear to be selling off right now. We've got a couple of things going on today that should be interesting to watch as we get, just to observe a couple of things. One is it's quadruple witching hour, which happens once a quarter. And then secondly, it's once a quarter, the indexes rebalance themselves. In other words, they have to buy and sell shares to make sure they're back in the proper percentage of, especially on these weighted indexes, so that they're in the proper percentages. There is a tendency, or at least this is what I have been told, and I'm going to observe this to see if this is in fact the case. There's a tendency that during the last hour of trading on the quadruple witching Fridays, when the indexes rebalance themselves, that there's a significant sell-off in especially the S&P and perhaps the NASDAQ or the NASDAQ composite as the index rebalances itself. And I'm going to be watching this today. I'll write about this weekend in the traders report. But as we see that we've hit this high at the 2050 level, which happens to be also a good level of a resistance zone, and we appear to be selling off a little bit. If we were to finish today with this particular candle, it would be a shooting star. If it finished right where it's at today. I highlight, and I know you have some comments on this chart also, Mike, but I highlight that one thing that the market likes is symmetry. And if we take this trend line, just drop from there to there, it's up about 13.4% from its low in February 11th. It's gone up for 26 trading days. Well, if we roll back in time to a very similar period, this was back in I guess the last trading day in September 2015 and the whole month of October. We go to this low here and we pull it up to this high here. That happens to be 26 trading days, and the market during that time frame went up about 13%, somewhere between 12, depends on how fat my trend line is, but about the same amount. What did it do then? After that, it completed that move, rolled over, bounced, popped back up, and that's when we started getting this negative divergence to the downside, which turned out to be very beneficial during this time period. And so are we seeing a similar thing, a symmetry between October of last year and February into March of this year? And I find one of the things I find intriguing, Mike, as we look at this, is that this ultimate high up here at the trend line is connected, and it's the same high that it made here. And so I find that as it's gotten close to that proximity, it's pulled back. So we'll see what happens towards the end of the day. Now, Mike, you had some observations on the on the S&P, or maybe it was one of the other ones that. And then the other thing I'll just point out right here, while the TSI is moving on to new highs, it is approaching its overextended of over a plus 50 on a daily basis. But as you can see, even though we're pushing higher with the index, the momentum of this move is starting to wane. Mike, I know you had some points you wanted to make on this.
Well, yeah, a couple of things. I mean, you mentioned earlier about, the rising or ascending wedge type formation that we've seen on the daily chart here. that's built up over the last few weeks. And, it was very similar in October.
Yep.
You can almost just look at that and see how they're almost parallel to each other the angle of ascent of those rallies. And, these ascending wedges, rising wedges, whatever you want to call them, are usually, almost always going to resolve to the downside when they finally break that lower trend line, which is exactly what happened in October. And, the sort of the vice versa to that is a descending or a falling wedge, which is what we saw happening here in January.
Yeah.
Where you had a very steep drop, and descending wedges are going to resolve themselves to the upside when they break their upper trend lines, and which is exactly what happened with that one. So the point being that nothing goes up in a straight line for an indefinite period of time, and nothing goes down in a straight line for an indefinite period of time. And those very steep wedges that we've seen here in just the past few months have resolved as they predictably, should resolve at some point. And it would be a bit naive to think that what's happening now won't play out ultimately in the same way.
Yep. So
bound to happen.
And this trend line here that I just drew in here, or actually I drew it over here and then transferred it over. Look, okay, this is the current ascent. This is the ascent back from October of last year. And while those aren't absolutely, exactly parallel, they're pretty darn close.
Yeah, they're close enough for government work, huh?
Yeah.
Yeah. Yeah, so that was one of the points I wanted to make, and then the other thing, if we can go back on the weekly chart or even a monthly chart on the S&P back to 2007, you might want to go to the monthly to go back to 2007.
There we go.
Because on Thinkorswim, I think the weekly default goes back 3 years. Okay, all right. There we go. The point being that if we look not in 2008 but in 2007, we can see kind of the back and forth that the market went through before the big collapse in 2008, and the market was making very similar moves to what it's been doing here recently. Right. The peak of the market there in sort of early to mid 2007. Went up to about 1570 or so, like around May or June, and then over the summer it dropped, to 1400, the 1570 area.
Right.
Go back to 2007. You're
right here.
Oh yeah, right on that almost shooting star type candlestick in mid 2007. Yeah, there you go. All right, so the high there, the high there was around 1540, 1550, something like that, and then we had about a 10% drop down to 1400 in just a matter of a month or two.
Right.
And then off the 1400 level, we got a nice rebound or a rally back up to about 1570.
Right. Right
which
here.
was, a little bit over a 10% rally. And, so for a few months there, the market was moving in this range between, 1550, 1570, and 1400. Until finally it lost, the 1400 support and broke loose to the downside in 2008. So what are we seeing now? We're seeing a market that's sort of vacillating and bouncing around between about 1800 and
2100.
2000.
Yeah.
2100. And it's made, a big move to the downside a couple of times, and it's bounced back up off of that support, pretty strong bounces, but could never really break out. And we're just seeing the same kind of thing happening in real time. We don't know yet how it's going to play out and resolve. but we know how it happened before.
Yeah.
And that was the other thing I wanted to point out today.
Okay, cool. So, yeah, I mean, these are areas that we've been watching and watching, because you got to remember that, Mike and I uh, first started talking about this rounded top. I remember it well, Mike. It was back in March, or it was about March, April, May, June of 2014, where we were saying, okay, there's a fundamental shift going on with what's going on with this market, and what were we seeing is all of a sudden our monthly momentum, and had started to slack off dramatically. And also we made a high, but all of a sudden on the TSI we were making lower highs on a monthly chart. And that was during, take a look at this. That was during this period. This was during 2014. And as soon as we come up into 2015 and couldn't break that, we were both saying, look at that. That's appearing, it's looking like it's going to be a rounded top. We'll see if it continues to be that way or not. Jorge brings up an important point, Mike, is that part of the rally that's been going on since February 11th is the result of a lot of short covering. There was a lot of people who were short the market, and Tesla is one of those. I mean, the move in Tesla has been amazing over the last month, but it's due to short covering. It had over 30% shorted stocks, and once they started covering those shorts, all of a sudden the momentum kicked in, and away she went. And Eric, you're absolutely right. And one of the things that I've noticed is when the momentum starts doing this kind of stuff, and where it's kind of directionless, where it's just kind of zigging, zagging around the zero line, that often can mean price action on the index itself, or the entity that is measuring is it tends more to move either sideways to just slightly up or slightly down, but the trending momentum has slipped away, as we see. Like here we have a period like that, and this goes into where we were just starting to break out, but there's not a lot of great trending. Tesla just opened a new dealership in Red Hook, Brooklyn. Cool. Gino, well, is that actually a place?
For it.
And so,
no, it's a really good point. I mean, this rally did start out as a short covering rally, which would explain how fast and how steep it's been going on relatively light and below average volume.
Yep.
Yeah, absolutely a good point, and absolutely right. There isn't, when you see rallies on light volume, it's often an indication that the people who are short are buying the positions back to right. Zero them out or cover them. But when the volume isn't up to snuff with the price action, it tells you that there isn't a lot of conviction in new buying and new long, net long positions on the part of the institutions.
Right.
And it's just a really interesting observation to make. It doesn't change the price action, but I think it does help to put it into perspective. And the other perspective, we were looking at the monthly chart there for a moment, and we've said it many times before that tops tend to be a process. And we saw that process play out in 2007 over a period of several months. In fact,
yes.
A good portion of the calendar year of 2007 was a topping process, and we've seen it here now, going back a year or maybe even 14 or 15 months.
That's right.
Where we've made no real price advance. But we sort of keep clicking up against the top here, and it can be a very long, drawn-out process, but it is seldom the event that bottoms are. I mean, in 2009, the markets dropped right into a bottom and bounced right out of them, and in February, 5 weeks ago, the market's sold off into a bottom and has bounced right out of it. Well, you don't usually see things falling out of the sky in quite the same way that you see things bouncing out of a bottom. And it's my belief that's what we're living with right now.
Yep, and great points. Let's see, let me get back over here to the daily weekly. Spent a lot of time in the S&P, but I think the S&P, since it is the apparent strongest index, I think it was worth the time spending on it and what we're seeing. Here's the Nasdaq. It's right as of right now. The Nasdaq has tried to push through the 200-day moving average, and it appears to be failing. We will see if it closes below the 43.89 level. We will have a bearish engulfing of yesterday's candle. Now, yes, we still are in this uptrend, and the uptrend, and I'll leave it to y'all to go. Y'all, I must have spent a lot of time in the Southwest, huh? Is basically go back and do the same comparison that I did on the S&P from this September 29th period up to this high, and do that measurement technique to say, okay, if the index is seeking symmetry, what is this telling us? What is this telling us? Gary has a question. What confirms the topping is done and dropping has started? I'm going to go back to, that's a great question. And there are several different interpretations of that. I will give you one of them. Remove that drawing. Let's draw a trend line across the, I'm going to go back to the S&P. You're probably getting a little bit more of a technical analysis training session than you expected. But that's okay. I'm going to get rid of my drawings. Maybe. Remove all drawings. Yes. Okay. A lot of it you're not going to know until, thanks, Eric. A lot of it you're not going to know until you get some repeats of retesting of a prior level. And so what we get, and in other words, if I take this as my first test of the 1823 level, and I extend this way, as it turns out, now there has been, okay, this tells me that once we started testing this and then started to roll over, it was telling me that in reality, I can say, okay, definitively, the topping pattern started about the 1823 level. It has now come up and started to round over, and it is now, has dropped back down and retested it 2 more times. So it's retested that level 4 different times over the last since. So this was telling us that we were going to, starting a topping type thing by somewhere between February and April of 2014. But we only know that by 2020 hindsight now because we can see what the chart has done. And so if this trend line holds, which it appears as if it is, don't do that. Draw a little trend line across here, and which it won't be absolutely exact. As you can see over in the weekly chart, because on the weekly chart I could also draw this across here like this or like that on the S&P. But for, as Mike says, close enough for government work for right now, but it gives us an indication, okay, if this level holds here, then that's telling us that we're most likely, if it starts to roll back over, we're going to most likely roll back down, break through these moving averages, and potentially hit this section again. It's when this section is basically violated, further down, like let's say it drops 1800, then we'll see if we have an acceleration of the selling at that point. But that would kind of define, to ask your question, what confirms the topping is done and the dropping is started. It's when that strong level of support is finally breached and it appears to be breaking further to the downside. You want to add anything to that, Mike?
No, not really. I think it's a really good answer to a really good question, and I kind of agree with that. Yeah, well, I guess the only thing I would add, Dennis, and you and I have talked about it before. I mean, when you get multiple tests of support or multiple tests of resistance, kind of like hammering or beating against something. I mean, sooner or later it breaks.
Yeah.
And so how many times, if you're trading a bounce off of support or, a pullback from resistance, how many times can you reliably do that until that support or resistance level breaks?
Yeah.
And, for me, the guideline on that is that, the first test of support, the second test of support, those bounces generally tend to work out pretty well.
Right.
And after a couple of times, they tend to become more unreliable. If this thing's going to go down to about that 1810, 1820 area,
correct,
for a fourth time or a fifth time, that's probably not the bounce that you want to count on trading. Again.
Yeah, exactly. Because you got a couple of things working for you. You've got your overhead supply or overhead resistance is getting closer to your bounce area, where if you did ping pong back up, you're not going to get much of a bounce as it continues to grow. And one thing, Mike, I like to compare it to, imagine you got a concrete wall and you hit it with a sledgehammer once, twice, 3, 4, 5 times, but once that, the final, it's just a hair, worth of additional hits right before it goes catastrophic. And once it goes catastrophic, you get, well, here's a great example over here. I mean, look at going back in 2007, 2008, is you had this level of support here down at about the 1270 level, and it had been hit several times, or you can even go a little bit further, but let's say that's it right there. And it had come up, hit off it twice, and in this particular case, we had everything still rolling over, and this, like I said, this trend line that came down through here, tested that trend line, then fell, tried to retest it, but then it was just finally the final little push. Exactly, cracks develop in the wall, Gary, and finally, once those cracks get large enough, it just gives way. And any of you who've done any catastrophic testing on materials in a engineering lab, you know that once it goes, once the failure goes catastrophic, it's, watch out. That's when people get hurt. So good discussion today, guys. Thank you very much. Russell, let's go back to the Russell. Let's type it in properly. Russell, there we go. Okay, Russell actually is broken back out and appears as if it is going to try to move higher. A couple of things to be on the lookout for, though, is one, it is moving up into a, let's call that a level of resistance right at these past swing lows. But what's happening down here? It's moving in new highs, but both the TSI and the momentum are not. And so similar type of picture for the Russell. And so it's kind of interesting. I really don't have a lot to cover on the Russell. well, if it gets past this level, just above 1100, then we're probably looking for, a potential retest up in the, this area up here around that downtrending line. And as long as Mike has used this example of this chart again and again and again to say this is a perfect example of a downtrending entity. And this would be the first leg. If you're a wave person, this is your first wave down. This is your second wave down. And oftentimes your third wave down, whenever that happens, tends to be, can be more significant than the preceding two waves. I know you're not a wave person, Mike, but is that what, in your reading, are you finding a similar type thing?
Yeah, wave 3 usually tends to be the biggest in magnitude and also the longest in duration. And on the downside, usually you can expect 3 waves of selling.
Yeah.
Before the selling kind of just is spent, and the markets are ready for a truly significant, lasting rebound. And you're right, we've had 2 waves of selling in the Russell here, and if those rules still apply, then we should be able to expect a fairly pronounced third wave of selling, and whenever that bottoms out, you're going to have a very long-term cyclical bull market resulting out of that bottom,
yes.
Most likely. Yeah, I think that's all right on.
And so I want to just share this with everybody just real quick. This is basically, remember I said the market loves symmetry, and basically doing a Fibonacci retracement where we measure from this high to swing low here, back up to the swing high here, and let it project out. Well, that next move down was it overshot the 100, which is where we expected it to go, but then it overshot that, but then reversed fairly quickly off that. If we do something similar for the swing from
this is great. I mean, I'm really interested in this. Let's assume that today, at 1100 is the high for the Russell, and let's do an extension to the downside.
There you go. I just did that. You ready?
Yeah.
Okay, I'm going to switch over to I don't know what I'm going to switch over to. I'm going to switch over to a monthly chart to get a flavor for that. And so,
okay, yeah, well, terrific. All right, so downside projections, and again, it's based on making the assumption that the Russell is going to sort of peter out here at 1100, and you look at the common extension levels: 23.6, 38.2, 61.8. Look where that potentially could take the Russell.
Yeah. And so, I mean, look at, and one of the things we look for, we were talking about convergence of clues the other day. Look at this convergence of a really dynamite clue is right here at the 866 level, which was the high from 2011, is just, so that I would consider that a convergence of clues, and also a support zone. That is very real. That we would.
Yeah, that support even goes back, just looking back to like 2007. I think the highs there were approximately in that ballpark.
Yeah, and if we extend that,
850, 860 area.
Yep, there it is right there. I just drew it in. It's this lower line here, but that gives a very good confluence of clues that if the market maintains symmetry, and which it tends to like to do, this drop, this gain, and if this happens to be the top, we'll drop, we'll drop it out of the sky fairly well. Let's just do a real quick. I want to do one more speculation, if you will. And I'm going to basically take from, we'll see how it works out over here. I'm going to basically do a similar type of fib extension from this swing high here to this swing high low here, but I'm going to say it's going to make it back up on a weekly chart, back up to the 40-week moving average, which is approximately there. Isn't that interesting that actually just tightens us back up? But so I apologize, guys, for spending so much time on that. Well, I don't apologize, because I think it's if you're thinking about where the market's going to go next week, and also looking forward to not only next week, but where might it go next month and all that kind of stuff. Knowing these kind of things is very vital.
Well, and I think the bigger picture too is, and the usefulness of this exercise is, let's say that in the next several months we get a big full-blown bear market.
Right.
Let's say that happens and things really start to spiral to the downside. Well, if the Russell, you can make a note of this somewhere or stick it in the back of your head. If the Russell is starting to approach that 850, 860 area, and from 1100, that's nearly a 25% drop.
Right.
You may want to, take some serious long positions on the index ETFs or the leveraged index ETFs around that price level.
Yeah.
Because it seems to be should serve as a very strong area of support if it ever gets there.
And so, yeah, I just wanted to share with everybody really quick, again, this concept of the symmetry of a trade, and this is basically just this move up, this move down to the new swing low on the Russell, and then where did it start? Where it took off and went very nice. So once it broke above the 100% level, it tried to stop at several of these individual Fibonacci retracement extension levels. In fact, successfully stopped, got up here to the 200% extension, and just basically went sideways. And yes, it did go a little bit higher than that, but I would venture to guess that that's going to correspond fairly well to a, I won't put it in right now, but another extension level. Let's bop this one out of the way, remove, and yes, no, got rid of all the drawings. Oh well. If we take this extension here to here to here to here, again, look what that tells us. This symmetry. It gets up to the 61.8% retracement, then fails, comes back down to the 0, and look how it stalls out once it gets back into the approximately 100%. And this is where we would have had, if we put 2 of them in there, you would see multiple levels of fib extensions at those levels. So, hey guys, we're going to finish up. Are we seeing a continuing rally? And we see all-time new highs and one waiting for a full-blown bear. Yeah, that's again, Scott, what we're trying to say is as long as, Scott makes the point of, if we wait for the bear market, we may miss out on a lot of upside. And that's where, within that wedge that's moving up, as long as we're still within that wedge, we can trade to the upside. The clue that's failing is, one of the clues that it's failing is if it breaks that wedge to the downside. And as Mike said earlier, very seldom, if neither one of us can remember a point where ascending wedge where it broke to the upside. And so,
yeah, the corollary to that is that you don't see descending or falling wedges, break to the downside.
Yep.
They tend to break back up to the upside.
And so what I'm anticipating for next week is basically we may get a little bit, continue to push higher. We're getting close to resistance level. Anticipating maybe it would be nice to see just a slight pullback and staying within that wedge for a potential long long, long play to the upside. And again, watch for it to push up to resistance and see what it does there. Here's where we are this week on strategy 3 has been working very good for us. And we'll see some more option tradings going next week. The BAM meeting is coming up first Saturday in April. April. Ashi David is going to be presenting for us, and he's going to be talking about when to close a trade. That's for protecting profits and also protecting capital. And so if you do have a group, be glad to present to anybody. At Active Trend Trading, we try to follow the 5 pillars of active trend trading, what to trade, and a lot of times that is just identifying potential trading ideas. And I really love it when members say, hey, I took that idea, like we had one person take the idea on PayPal and has done very good, and also NetEase and has done very well over the last couple of weeks. The active trend trading, that's our foundation, and then we base our strategies off of that. And if you're watching the recording or you're not a active trend trading member right now, please join us if you are watching this recording, and for a 40% saving on the active trend trading membership. That's a monthly, and the early warning alerts on index ETFs. Good savings there. So with that, Mike, thank you so much for being for being online.
Okay, glad to be here, and I'll talk to you later.
Okay, and everybody, please have a great weekend. Remember, next week is a short trading week. It is only 4 days with people being off on Friday. Friday of next week. I'm going to show a couple of charts, and then I will look at a couple of charts if anybody has some that they want to look at, and then we'll call it a day. And I hope the little bit of technical overview that we did do today was beneficial. I want to show a couple of things. The person who wrote me about getting into NetEase. Here we go. Okay, they got into NetEase approximately where the 8-day crossed the 20-day moving average, or is bouncing here off the 100-day moving. No, 200-day moving average, as it started to move up. It went up, hit a resistance level, put in, one of the things we always want to watch is the reversal candlesticks. And this was a good shooting star, but adding to it today's action, you're looking at an evening star type formation, which is basically a bearish signal. If it's voided, it's going to hit here off the 8 and 20-day moving average and bounce back up. We'll see if that happens. But if you did get into the trade approximately at the 145 level, and you had this shooting star, even if you got out, not out of the total trade, but maybe pulled back some of your profits, you're going to pull down, about 5% profit after hitting this resistance level. And right now we're seeing this bearish indicator play out. A couple other stocks that are looking interesting. Starbucks. Believe it or not, Starbucks looks like it may be. Looks like it's trying, kind of a inverted head and shoulders kind of pattern, and it's trying to bounce back up and get its moving averages back into an uptrend. Downside on Starbucks is this. This last little wedge up was done on lower volume profile, like we're seeing so much with some of the other indices. You got in at 143 on NetEase. Excellent. So did you pull some profit off? And so Starbucks, here's a stock that I'm watching that looks interesting. And it's in this symmetric triangle. And so it's approaching the point where it's going to go either explode up the top of the triangle or down below the triangle. When you're interpreting triangles, basically from the beginning of the triangle as it moves its way across, as long as you're in the first approximately 2/3 of the triangle, it will be that's a good thing for a potential breakout. If you get further towards the what would be the apex of the triangle, it loses its significance. We've got a couple of stocks to look at. Palo Alto Networks. What's Palo Alto Networks doing? Okay. It's consolidating after this move up again. Not going to say it's not going to move higher, but this volume profile is concerning. This was good volume profile as it was buying up after earnings. And so it does seem like it's wanting to get itself in gear. And if you trade the moving average envelopes, when it moved up out of the envelope and moved up with earnings touched, you can basically, you're expecting some kind of move where it's going to come back to the moving averages and move up, and it sometimes does that by moving sideways. So we've got some resistance here, just below about the 159 level. And so let's see if we can get some volume to kick into this. It would be a great trade, an okay trade off the 8, or if you get to pull back to the 20 or even the 50, that might give you a potential bounce depending on what the rest of the market's going to do. MXL. Okay, MXL. Yeah, nice looking little breakout. I don't know what MXL is. Max Linear. What do they do, Tracy? But you're getting a nice buying volume. It's average, nice buying volume down here on a daily chart. It's moving back up. You have a nice breakout of almost just basically not a cup and handle, but just basically a cup type formation. And it's continuing to move up. It is at the moving average envelope, so we might get some reversion to the mean, but well worth keeping your eye on, Tracy, if you're not already in it. Again, I'd wanted to use the stock checkup on it to make sure its fundamentals are okay. WFC. Okay, WFC. It looks like it's working on kind of a inverted head and shoulders type pattern. Shoulder, head, shoulder, kind of a neckline, maybe across here or maybe up into that area. It's breaking out. It is below. Here's the 200. Here's the 100. Here's the 200. It is below those. And so watch. It is not a very. It doesn't move a lot, as you can tell by where the moving average. This is a 10% moving average envelope. So very seldom does it get up. It's not a big mover. And that's Wells Fargo, is it not? It is Wells Fargo. And so, as long as this trend line here, get rid of the, as long as this trend line from here stays intact, you can play to the upside. This is another one of those ascending wedges, and so that's kind of interesting. We're seeing repeats, and this is since it's a financial. EEM. Yes, Tracy, we will. There we go. EEM. This is emerging markets, and it has reversed its trend that we've got. Here we go. This trend here has been reversed, and it is back up to the 200 moving average. We could anticipate resistance there, so we might want to look for a pullback towards the 820, And emerging markets, these big gap ups is because it trades overseas. So, okay. Jeff says that the Wells Fargo is a 401k stock for him. And so, yeah, Tracy, we've gotten through the first quarter and of the year, or just about through the first quarter of the year, and that's part of my time from the aspect of I'm very cautious during the first quarter because that can be some of the most challenging time for me to trade. And now that we almost have that behind us, you'll start to see more trades come out as the market rights itself. And it's just I am very cautious with not wanting to, put people, as people who parallel trade with us. I don't want to put them, into a bad situation, and so that's where we're working at. So, hey, that basically, I just want to show a couple of more, and this is a trade that I missed, but we did highlight it, and that was Nike as a potential pre-earnings run trade. And it's got earnings on the 22nd, but it came off of this support at 58, put in a hammer, which also happened to be a bullish harami, and then took off on a jet, from there, and took out this highs here. There is some indication, as you can see, okay volume, not great, but this was purely a pre-earnings run. We highlighted it as a potential get into over in this area. It continued to drop and then bounce from there. And so if one was watching that for a potential bounce off that 58 and got in, you should be very profitable. And then the other one, INCY, this week, highlighted this as a potential short when it was up in this area. And sure enough, we got the drop from 69 all the way down to about 60, and so that would have led to a really quick move. And so, okay, folks, with that, I'm going to call it a day. I've got to finish up the rest of the market. I'm going to go observe the S&P to see if, in fact, it does sell off into the close as it is rebalanced this weekend, today and into the weekend. So have a great weekend. And yeah, no problem, Tracy. It's patience is a virtue, they say, and I know that my patience sometimes has gotten short in the past, but one thing I have learned is staying patient will be rewarded over the complete trading campaign of a year. So God bless everybody. Have a great weekend.